Hi, Jeff Higley with Hotel News Now. We're here at the Lodging Conference 2018 at the Arizona Biltmore, and with me today is Doug Kessler, the President and CEO of Ashford Hospitality Trust. Doug, thanks for being here. We appreciate you joining us. So talk a little bit about, out of the gate, the 15 years that Ashford's been around. You started, I think it was May 13th, 2003, you incorporated. So now 15 years after that, how would you describe the company? What's the overall description that you would use?
I'd say we've always been an opportunistic platform. We've taken advantage of opportunities in the capital markets along the way. We've certainly bought and sold, we believe, at the right time, and we've aggressively asset managed. So over the history of the company, there's been a concerted effort to capitalize on situations in the market and to constantly have a focus on adding to shareholder value. One of the key reasons behind that is because, unlike most of our lodging REIT peers, we have the highest insider ownership at about 18%, which is almost 6 times that of our peer average. So we're very much aligned with our shareholders, and we think and act like owners, and that's basically what we've done over our 15-year history.
Okay, so if you could describe your current investment strategy or your current strategy overall, and I've got to cheat here a little bit because you have something called the Enhanced Return Funding Program.
That's correct.
So that's something new for you that you've kind of developed to help move this strategy along. Can you talk a little bit about the strategy as a whole and then that program in particular?
Sure. Our strategy as a whole is very simple. It's very focused. It's to acquire full-service upper upscale hotels. And the ERFP program, or the Enhanced Return Funding Program, is a significant competitive advantage. None of our peers have this program. And it was derived out of the relationship that we have with our advisor, Ashford Inc. Very much a symbiotic relationship. This was intended to be a win-win for their shareholders and our shareholders. And the way it works simply is that Ashford Inc. has provided a $50 million programmatic commitment to apply to 10% of the purchase price of every asset that Ashford Trust buys, effectively up to $500 million of new assets. So that $50 million would equate to $500 million of new acquisitions, where Ashford Trust would receive that $50 million of funding. And the beauty of the program is that, as you can imagine, that $50 million is funded in a way that reduces the equity requirement for Ashford Trust. And if you think about a typical capital structure where you have, let's say, in our case, about 60% non-recourse property level debt, about 10% of our corporate capital structure is preferreds, that leaves about 30% equity requirement for a new deal, in general terms. Well, if Ashford Inc., through the ERFP program, is funding 10% of the purchase price, that equates to 1/3 of the equity that would be no longer funded effectively by Ashford Trust. You can imagine the power of this in terms of what it does to elevate the internal rates of returns on these investments.
What's the ideal number of hotels that you could acquire through this program? I know you said you're disciplined, so
Right.
What would be an ideal number per year?
Well, we don't have a target per year, and again, I think we'll be looking to make good deals great, so we'll be disciplined, and obviously the pipeline today it's competitive, but over time, and the fact that this ERFP program has a 2-year commitment, clearly it's in Ashford Trust benefit to utilize that capital. And so our target would be to utilize it fully in that 2-year period, and that would equate to $500 million of investments. Now, we've already bought the Hilton Alexandria Old Town, which was $111 million, so we're on our way, and our goal would be to find additional investment opportunities to benefit from the deployment of the ERFP funding.
One of the other things that you all have done this year is refinance a number of your properties, a number of portfolios. I think there was a portfolio of 8, then one of 22, and then one of 34 over the course of the first 8 months of this year. Can you talk a little bit about the refi environment? Why is now a good time to do it, and what are the benefits derived from that?
And the reason why we've had so much refinancing activity is several. First of all, most of our debt is floating rate debt. We believe in the benefits of floating rate debt because it gives us flexibility to refinance, it gives us flexibility to sell, and we like the natural hedge between the movement in RevPAR and the movement in floating rate index. We purposely refinanced a great deal of our debt over the past couple of years. Almost 85% of our debt we have refinanced, in excess of $3 billion. And the reason is that we have observed historically, and one thing that we pride ourselves on in our organization is to really look academically at the facts and figures of what the current trends are, the data, and what we've seen historically. And what we anticipated is that when the Fed was going to raise rates, that the spread on loans would reduce. We've seen that in prior cycles, and in fact that's exactly what has happened. The index has moved up, LIBOR has moved up, but actually the spreads above LIBOR have compressed. And we wanted to capitalize on that opportunity with all of our floating rate debt so that we could benefit from these compressed spreads, and that's exactly what we did.
Can you talk a little bit about REIT consolidation? You know, we're seeing Pebblebrook, LaSalle. You guys went after Falcor. You know, it's long been thought that the hotel industry would possibly be better off with fewer, bigger REITs than a lot of smaller REITs that exist today. What's your take on that?
I think you're right that from the standpoint of greater liquidity, greater scale, matters more today. I think that, number one, it gives companies greater access to capital. And secondly, there's been a trend in REIT world where, and particularly in the lodging REIT land, where the growth of passive investment funds is certainly capturing more and more of the ownership pie of lodging REITs. It used to be that the dedicated REIT investors dominated the landscape of capital. And today you've got quant funds, hedge funds, other passive type index funds that are capturing a greater market share of every REIT. And so for that reason, having more liquidity, I think, is of benefit to various REIT platforms. Mm-hmm. So I wouldn't be surprised if we see more consolidation. Certainly companies have to be thinking about it, boards have to be thinking about it, and so we'll have to see what happens in the next year or two.
I got to ask, do you have your eyes on any particular company right now?
No, I can't comment on that. I think we're always looking at opportunities to enhance shareholder value, whether it's single asset investments, portfolio investments. Obviously, we've had a great track record with respect to complex transactions. We ended up owning Highland Hospitality, which was a former publicly traded lodging REIT. We ended up, through a initial debt investment with a partner, we ended up taking full control over that company, one of the best investments we've made for our shareholders. And even prior to that, we teamed up with Morgan Stanley's real estate fund in the joint acquisition, if you will, of CNL Hotels and Resorts. So clearly our management team has the expertise and the bandwidth to address complex transactions. So again, we're an opportunistic platform. If we see the right opportunity for our shareholders, it's our job to pursue that to the fullest extent possible.
So you mentioned the cycle and the length of it. It can't last forever. So how do you, as president and CEO, prepare for the inevitable downturn? How do you look at it? Are there any indicators that you kind of will say, okay, now's the time to really pull the reins in?
Well, we're constantly tracking all sorts of financial data to inside our industry and outside of our industry to monitor the trends that are taking place, both with respect to lending, because I think lending lends itself to sort of the grease to the value creation, because if you can't access debt, then obviously that's going to start having an impact on values, which would translate to an impact on lodging REITs. We're tracking, as you can already tell by my earlier comments, the labor statistics. We're tracking corporate profitability. We're looking at early indicators of predictability of recessions. We also have a unique benefit in that we have 60% of our EBITDA managed by our affiliate Remington, which is an organization that we've worked with since our inception. We believe they're more nimble in a downturn, and so I feel like we have that extra embedded benefit to any sort of economic shock. No one can be totally prepared, but I think we have a good history, and we're certainly looking over our shoulder at anything that we should be concerned about, and we'll continue to do so. You're right. Trees don't grow to the sky.
That's right. That's right. Doug Kessler, President and CEO of Ashford, thank you so much for being here. We appreciate it.
Thank you very much.